Welcome to Market Call, and thanks for joining us. I'm Morella Fernandez. Gordon Reid with us on the show today, President and CEO, Goodreid Investment Counsel. He'll take your questions on American equities. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Gordon, good to see you. Thanks for coming in.
Thank you, Morella. Nice to be here.
We get an announcement in the U.S. later today from the Fed, a rate cut highly expected. Do you think the rates as is have been too restrictive so far?
Yes. I think the Fed is always late, and that's not a fault. That's the result of the process.
There's late and then there's too late.
Exactly. And only the history books will tell us whether we're too late. Too late means that they don't act until there's an event that they could have prevented if they'd acted earlier. And there's no indications that I can see that the United States economy is in any kind of harm or in the path. Yeah, in the path of harm. But these things can happen fairly quickly. There's no question that the labor markets are weakening, but weakening is a lot different from weak. And Fed Chair Powell has been very fond of saying they're data dependent, and they've got to wait until they see something, until they act, and they just can't act on an impulse, an idea, a thought. This is a very serious issue, and they've got to be measured. I think they are being.
How big of a cut do you expect, and what's your reason behind that?
I expect 25 basis points. I think they easily could do 50, but 50 might send the wrong message. So if the market perceives that they're lowering rates because they're fearful that the economy is weak, they're fearful that maybe they are too late, it's going to react very poorly. And I don't think the Fed wants to upset the markets. They want to be sort of benign as it pertains to the market, not one way or the other. So I think for that reason, they'll do 25 basis points. But I think it's not a very well hidden fact that this is just the start. I would fully expect that before this cycle is finished, that we're going to see at least 100 basis point drop in rates, and it might move into 26, but this is just the beginning, and I think the markets will likely react to that. It's going to be interesting to see how the markets do react to the afternoon press conference. I don't think they're going to react to the 25 basis points.
But what are you expecting from that news conference? What are you hearing? What are you waiting to hear?
Well, I'm waiting to see whether they're dovish or hawkish. I'm waiting to see how many dissents on the board there are. So how many of the board members actually would have preferred 50 basis points? I'm looking to see just how the market grapples with the message that's coming through both the written side, being what it is and what the dissents are, what the dot plots are, that's the future expectation for rate movements, and what the nuances are, how Fed Chair Powell answers questions, whether he seemingly comes across as more dovish or more hawkish.
Why is it so important to you to understand who has voted for what or how many have voted which way?
Well, it's become highly politicized, hasn't it? It's well known that President Trump wants to see rates fall, and he's populating the Fed with so-called his guys.
Yeah.
Well, this isn't new. I mean, we can go way back, 70 years to the times of Nixon and Ford, and there's been many presidents that have pressured the Fed to move in a certain way, and in fact appointed people that would do their bidding for them, and it hasn't always worked out so well. So I'm one who is in real favor of the Fed remaining as independent as possible, but I understand the reality of the politics surrounding it,
which are very, very strong at this point. All right. Gordon Reid is our guest today, Goodreid Investment Counsel, taking your questions on American equities. Here's how to reach us if you have a question. We're back in a moment. Welcome back. We're going to start with an email right now. Tony has written in. He says, please give me your opinion on Pinterest, P-I-N-S, on the New York Stock Exchange, which does run ads. How is that working out for them?
Well, it's working out well. Their growth rates are impressive. They are a social platform, and of course, social platforms have taken over the world. It's about control of the eyeballs in the world and how many monthly active users you have. And they have done well. They've got well over 500 million monthly active users, most of them outside of North America, which is interesting. Only about 100 million in North America. You know, they've been growing well, but they've got big competition. I mean, when you think about who else has a social platform, you can just run a long list, right, from Instagram to TikTok, which is in the news today, and Twitter, and in their particular space, House is another one. So there's lots of different platforms, but as a society, we're spending an incredible amount of time surfing our computers or our phones. So it's certainly a lucrative area. It trades at a reasonable multiple, and it's got good growth rates. The expectations moving forward are a mid-teens growth of EPS earnings. So, you know, somebody wants to take a position there. I wouldn't have a strong argument. The only thing I would caution is that they're a standalone. So how wide is their moat, and how do you protect against infiltration by a better platform? Well, the way I would look at it is I'd want to not try to guess the future. I'd like to have other soldiers. So I would go with perhaps a Meta that has a platform, Instagram, that's a part of a much bigger organization. That's how I would invest in this area.
More iron in the fires, as we used to say.
Sure.
Okay,
Yeah.
Let's go to the phone lines. Richard's on the line in Ottawa with a question. Hi, Richard.
Hi, thank you for taking my call. I'd like Gord's opinion on Honeywell. Does he own it? And whether he thinks this is a good entry point, if he does. Thank you.
Thanks for the question.
You know, Richard, we don't own it. We have in the past. Obviously an industrial, very good company, somewhat expensive against its historical multiples, but that can be said about a lot of industrials. I would say that in looking at Honeywell, you would always want to do peer group analysis, and even if you broaden that out to the industrial sector, it's a sector that's done extremely well, and that means there's lots of choice. So Honeywell really, for Goodreid, great company, good company, I like it, but it just gets knocked out by what I would classify as better competitors. So we don't own Honeywell.
Where would you put your money in that space if you were advising him or giving him some other choices?
Well, we particularly like the infrastructure space, so industrials that are involved in infrastructure. We own a company called URI, United Rentals. We own a company called MCOR, which is a construction company, does fittings for industrial projects. You can get into the data center space. Eaton is a great example of that, where their electrical division is just on fire, you know, building out these data centers. So there's lots of things to look at, and those are some of the areas I would go. One other companies that we own in our big cap portfolio is Raytheon, RTX.
Okay, same space. Got it. Let's go to the phone lines then again. Ross is on the line. He's calling from Windsor, Ontario. Hi, Ross.
Well, good afternoon. Thanks for taking my call. I'm interested in Gord's opinion on Berkshire Hathaway. They've had quite a hoard of cash there they're sitting on for quite a while, and the stock hasn't done very much for the last year or so. If we could get your opinion. Thank you.
Thanks for the question. Go ahead.
Yeah, Berkshire has they've made a bet on the market. They've got, as you say, a large hoard of cash, somewhere in the neighborhood of $350 billion. And this afternoon's announcement certainly won't help that. Interest rates are going lower, especially in the short term, and they're the biggest buyer of Treasury bills in the world. So you know, it's a bet on whether there's going to be a correction in the market, and so far they've been wrong. I personally am not someone who's in favor of trying to time the market, and it's hard to speak poorly of Berkshire. They've done so well over the many decades, but that's not our particular style, and we remain relatively fully invested in the market and take the ups and downs of the market. So that's just our approach.
Got it. Okay. We are going to move to John in London with his question. He's in London, Ontario. Hi, John.
Thank you, Marilla. Hello, Gordon. Gordon, I would appreciate your peer group analysis on U.S. banks. We own too many of them over here. Some are doing better than others in the past while. J.P. Morgan, Goldman Sachs seem to be going up well. I would appreciate if you could, say, rank the U.S. banks in anticipation of this interest rate change. Thanks very much.
Okay, thank you for the question.
Yeah, ranking is difficult because you have to look at the criteria on which you're ranking them, and there's a number of components that would be considered in coming up with a final score on a bank. In terms of quality, it's hard to argue against J.P. Morgan. You know, they're best of breed. Goldman Sachs on the investment banking side. And if you're looking at valuation and opportunity, probably Citigroup on the other side would be, you know, a very, very good choice. In the middle, you've got money center banks like Wells Fargo, Bank of America. Bank of America is a bank we own, and it's sort of middle tier. It's not as inexpensive as Citi. Probably doesn't have quite the pedigree of J.P. Morgan, but they're positioned very, very well to do very good things on the earnings front with a steepening of the yield curve, and their net interest margins are going to be most impacted of many of the banks. Excuse me. So, you know, that's a few comments on some of them. In the large cap portfolio, we own J.P. Morgan, Bank of America, Citi. We also own Goldman and Morgan Stanley.
So you've gone across the board with them.
We are overweight banks, Marilla, and we've been that way for quite some time in anticipation of exactly what we're going to see start this afternoon. And they've done well, the group has done very, very well in anticipation of this happening. You know, the whole idea of investing is to get ahead of the money flow and not chase it. And that's what we've done.
Okay. We're going to take a quick break. Gordon's sticking around, of course, to take your questions on American equities. Back in a moment. Welcome back. And again, thanks for joining us. We're going to Joseph on the line, who is in Montreal today. Hi, Joseph.
Good day. Thanks for taking my call. Gordon, I know in the past you said Costco too rich for your blood, but we're down like about 10% from its all-time high. So I'm wondering if this is a time you think it'd be better to get into it.
Okay, Costco is sitting at $958.26 today. It's up a little bit, $6.19, and not a great deal of change over the last year. I thought it would be up a little bit more. Is this a stock you've owned before? Do you like it?
Like the company, we've never owned the stock. It's always been screened out because of valuation. To Joseph's point, I haven't liked it in the past because of valuation. I looked at it, in fact, this morning, and it's trading at 53 times this year's earnings. And, you know, it's a great model. The model is that they cover, or they make virtually all of their money off the membership fees, and a few percentage points off their product. And the product brings people into the store, and they work on a volume model. It's an excellent model, and it's recognized by the street, but just too expensive for our blood. And you know, you have to look at these companies in terms of what can go wrong. And if you go into a sustained negative economic period, there's going to be a lot of hurt on companies like Costco. And Walmart is another example, trading at very high multiples because the outlook is very positive. It's very sunny. And my first question is, what happens when it gets cloudy? And if I feel that I'm going to be exposed, then I'll stay away and go with something else.
And just a little bit of a side note, a lot of these companies at that price point import from China. Mm-hmm. have they been knocked down a little by tariffs? I know Walmart has said it absorbed the cost. Now it's going to start passing it on to the consumer.
Right.
Would the same be going on at Dollarama and Costco, places like that?
Most product that the retailers carry is going to be from a foreign jurisdiction. And the reason for that is that we've gone through a couple of decades of globalization, where it was just cheaper to produce in those foreign jurisdictions, and it made the model work. We're reversing that, but we're not reversing it over a couple of decades. We're reversing it over a very short period of time. Ultimately, these tariffs have got to be paid for by someone. And even though you might have companies that say, well, we'll absorb it, ultimately, the pressure is going to be relentless for them to pass it on to the customer. And it's just a matter of how, when, and for the least amount of damage to their brand or their company and stock.
All right. Let's go to Michael. Michael's on the line in Windsor, Ontario. Hi, Michael.
Hi. Thanks for taking my call.
Hey, Michael.
I have a question about Eli Lilly. What does Gordon see going forward with them? I know there's an expansion, and I'd like to hear his thoughts on the stock going forward.
Okay, thank you for the question. So this space really beaten down so far in the year.
Yeah.
Do you see turnarounds for Pharma coming?
Yes.
Okay.
But if
That's a very qualified yes.
If you ask me when, I'm going to be less firm because I just don't know. Cycles tend to last a lot longer than one would ever expect, both bullish cycles and bearish cycles. And the reason is that they're looking to extract the most pain they possibly can from potential investors, because they want, it's a process of strong demand, strong supply. Who's going to win the tug of war? I do see a turnaround in the space. I think Lilly has got a very good franchise with their GLP-1 franchise. They're winning the war against Novo Nordisk, although Novo has a great position in the diabetes, obesity fight. But Lilly is taking share. Multiples have dropped, which is encouraging. I mean, Lilly not that long ago was trading over 50 times earnings. It's now probably in the mid-low 30s. I would hope that it might get a little lower. If it does, it's going to continue to hit our screens, and you never know. I mean, it might at one point find its way into our portfolios. Not at this point. We'll wait until we see a firmer bottom than we've got now.
Okay, let's go to our next caller, Renata in Oakville, Ontario. Hi, Renata.
Hi, good afternoon. I'd like your opinion on Alphabet, not whether it's a pretty good investment if I bought it, but do you think $248 is a good price, or should I wait till it goes a little down? And in your opinion would be appreciated, how far down should I wait? I'll hang up and look for your opinion. Thank you so very much.
Okay, thank you, Renata. Alphabet today at 247.92.
Yeah.
So it's pretty up there.
Yeah, well, things turn very quickly in this space. It wasn't that long ago that Alphabet, Google, was seen as kind of likely to be the runner-up in terms of the race in AI. That's flipped, and now they're seen as one of the leadership groups. It wasn't that long ago that Alphabet was kind of written off because, well, search, which they have 92% share in, can only go one way, and it's not going to be good for the company. Well, that's sort of flipped a little bit. Now maybe there's reasons to nuance that, and there's going to be hybrid models. So, to Renata's point, the price at $248 from a price standpoint, it's run up. We tend to look at companies like this more on a valuation basis. So, how many dollars are you paying for each dollar of earnings, and how successful is the company? What's the ramp rate? If you look at the revisions on earnings and how steep are those revisions, that will give you a view into the future and tell you where the price might be down the road. So We own Alphabet in our U.S. large cap portfolio. I wish I could have a crystal ball and answer Renata's questions, but I just don't, and I don't want to misguide her by guessing. So I can tell you what we look at as a firm, as an investment firm, to try to determine whether we want to participate. And as we own it, our vote is very clear. We do want to own it. And every day new clients come to us, and we're buying on their behalf. So that's
even at the level it is today.
Oh yes, okay. Yeah. If it's in our portfolios, we're a buyer.
All right. Let's go to an email then. Anthony says, "Can I please have Gordon's opinion on Uber?" Same sort of question. Is it a good time to buy? We'll pull up the Uber line chart and take a look at where it stands today at 93.01. So it's down today almost 5%. It is sort of trading up and sideways a little bit.
Yeah, well, I think the upward move is fairly clear there. It's established itself as a true leader in its industry, and it's a nascent industry, but it's a very, very big part of our society, even though it's only 15 years old in terms of when Uber was first introduced to us. It's down today because of the news that Lyft has done a deal with Waymo to run autonomous vehicles in Nashville. A piece of one-day news. It's noise. Is it going to go higher? We believe so. We wrote a blog, in fact, that's on our website, Goodreid.com. If anybody is interested, they can go there and look at articles and insights and see the blog that we wrote that will give you a more fulsome description of why we own Uber and what we think it will do in the future.
Okay. We are going to take a quick break. We will have a look at Gordon's past picks when we come back. Stay tuned. Welcome back. We are looking at Gordon's past picks from exactly a year ago, September 17, 2024. At the time, he chose Citigroup, recommended at $59.29 US, now up to $101.19. A 71% return and a total return of 75%. What did you foresee with Citigroup? What interested you at the time?
Well, it was historically at an extreme low valuation. It was trading at, probably 58% of book value that we'd never seen before.
What led to that? Do you remember?
Mismanagement, mostly.
Okay.
You know, they had a series of C-suite movements. A new CEO came in, Jane Fraser, and basically set out her objectives and had to earn back the respect and the confidence of the street, which she did and has done and is continuing to do. So what we've seen in the last year is, solid earnings growth, but an expansion of the multiples so that people are paying more for each dollar of earnings, and they're paying more as a percentage of book value, and they're doing that on confidence. So what we saw, and I mentioned this earlier in the show, is one way to look at companies is on valuation. You can have an ordinary company that's trading very, very inexpensively. And if you see that ordinary having a glimmer of hope to become distinguished in any way, then that multiple will re-rate. It will revise upward. And that's the type of thing we saw with Citi. And
you're holding on to it?
Yes, yeah. We think it's still a very good hold.
Okay, let's get to your next past pick from last year. Microsoft on the NASDAQ at the time was $435.15. Now at $506.39 US, so 16% return there, total return of 17%. It's so hard to sort of encapsulate what these companies are going through, these sort of bigger tech companies. Microsoft is a little off from its high. It's trading sideways now. Did you sell it all at the top?
No.
You're hanging on to it?
Yeah, we've owned it now we've owned it a few times over the past couple of decades. This particular ownership period probably dates back 18 months. We bought it because we saw on a valuation basis it dip below its normalized range of valuation. It obviously is one of the leaders in AI development. It's one of the leaders through Azure in cloud development. It's got its partnership with OpenAI that will run for a number of years, and we think that's going to be very, very fruitful for them. Their return on investment on their data center spend, their CapEx, is impressive. And, you know, it's not trading excessively. It's trading at a premium, but it's also growing at a premium. So we go into the future and discount back to present values, and we get numbers that we like.
Got it. So that was Microsoft. Let's get to your third pick from last year. Griffin Core, which does, I guess, building products, building supplies.
Yeah.
What did you like about them? They were 67.60 when you recommended, up to 77.65, so 15% upside for return.
Well, this sort of goes back to what I was talking about with the infrastructure play, where a whole lot of private and mostly public money through infrastructure bills passed by Congress. And trillions of dollars is pouring in, whether it's the CHIPS Act or the Infrastructure Act, you know, you name it, it's pouring into opportunities. And companies like Griffin that build things out through their building products area. So they do doors and like fire doors and wall structures and, you know, I mean, just a basic building business. That's growing very, very rapidly. The other side of their business, which is the consumer business, which quite literally is picks and shovels. It's quite literally they make picks and shovels. Okay. And it's not doing so well. But what interested us was that the building side of the business had about 55% share and was growing. Trades very inexpensively, down in the low, 13, 12 times earnings, and is growing, 10, 12% a year. So again, very attractive when you look at it, and we liked the trend that the building side was overtaking the consumer side, and that would lead naturally to accelerated growth.
All right, we are going to leave this part of the show as we take a quick break. Gordon Reid will take more of your questions on U.S. equities when we come back. Welcome back. Faisal is on the line. He's in Toronto with a question today. Hi, Faisal.
Hi, Mirella. Good afternoon to you and good afternoon to Gordon. Gordon, my question is on Broadcom. It reacted very positively to the recent earnings, but since then has been selling off. Can I get your thoughts on it? Would you be a buyer at this point? And going forward, what would be the catalyst that will propel it further? I'll hang up and listen, and thank you again.
Okay, thank you for the question. So it is dropping. It's 4% down today, Gordon, to 345.
Yeah, well, I guess I'd start with the fact that semiconductors chips are difficult because they are cyclical, and the cycles tend to be long and on the downside, quite painful. On the upside, as we've seen with Broadcom or Nvidia, when you get an upcycle, it's great days. But you have to time your entry and exit into these things. We don't own Broadcom. In retrospect, who wouldn't have liked to have owned Broadcom? But you have to pick and choose and populate your portfolio with more risk-centric investments or companies and more stable companies. And I've got one in my top picks that is in this area, but I think has a less of a risk profile, and I won't say any more right now, but we don't own Broadcom at this point. In the future, depending on what the price does and what the backdrop looks like, it's always a possibility. We're always looking at industries and sectors, but at this point, we don't.
Let's go to Anita then. She is in Markham, Ontario with a question. Hi, Anita.
Good afternoon. Thank you so much for taking my call. Gordon, my question is on AbbVie.
Right.
I don't have much exposure to U.S. health stock. The closest is Stryker. Ever since I sold my holdings in United Health, luckily just before the CEO died, I've been hesitant to buy health stock. So what are your thoughts on AbbVie? I'll hang up and listen to you. Thank you.
Okay, AbbVie out of Chicago, Illinois. How do they do in the space? They're sort of biopharma?
They're biopharma. They're a spin-off from Abbott, probably 10 or 12 years ago. Okay. And they spun AbbVie off with the drug Humira. And Humira is one of the most successful drugs in the world. They did very well with it, and we owned AbbVie at that time. And we did extremely well on behalf of our clients with it. But we started to approach the patent cliff of Humira, where we knew that generics were going to take more and more share. The profitability of the lead drug would be less impactful, and we decided to exit. I must say, I'm very impressed with how AbbVie has dealt with that. What we predicted was certainly true. At one point, it represented over 60% of their total revenue. And they've been able to fill in the blanks with new drugs, with acquisitions. It's been quite skillful. But we decided to sell, but that doesn't mean that we can't be very complimentary about what they've done with the franchise.
Okay. Let's get to another caller then. John on the line in Toronto. Hi, John. John, are you there? Okay, we may have lost him, but he did have a question about Meta. We'll pull Meta up right now, have a look at where they're landing. I feel like we're seeing a lot of the tech go sideways, if not down these days. What's your take on what's going on with Meta here?
Well, Meta long term has a wonderful runway. They're again one of the very few companies that are just poised to take big share and do extremely well in the new age of
heavily
AI.
Investing in AI.
Heavily investing, but unlike what we saw in the late 1990s, where there was huge investment, but kind of a foggy idea about what the return on that investment would be. This is much more disciplined. This is huge dollars, but they're actually translating those dollars into returns on those dollars, and the expectations are that those returns will actually ramp. And Meta is positioned just for that. So we talked about social platforms earlier, and Meta is the king of social platforms, of course. They've got control of over half of the world's population in terms of using one of their products every single day. We're not talking about monthly, we're talking about every single day.
Because if they create it, if they don't create it, they buy it.
Well, that has been in the past their modus operandi, and very successfully. And they buy it, they nurture it, and then they monetize it. And you can see it through a number of different products. So we're very impressed with how they've operated the business. They've had a couple of missteps, I'd call them. I think the metaverse was probably one of them. You remember that?
Big one. He really wanted that
to go. He really wanted
that.
And we looked at it and sort of our head went sideways, like, what is this?
What is it? I think everybody
and
did.
To be honest, I'm still there. I don't really understand it. But they quickly pivoted, and to their credit, very profitable, growing very well. We own it, and we're going to continue to own it as long as they continue to do the things they're doing.
Got it. Okay, we're going to take a quick break, lining up more phone calls and emails for Gordon Reid of Goodreid Investment Counsel. Back in a moment. Welcome back to Market Call. Let's go to Rose on the line. She's in Milton, Ontario, with a question. Hi.
Hi, Gordon.
Rose.
I was hoping to ask you about Nvidia.
Mm-hmm.
As you can see, it had an all-time high back in August, and It goes up and down, but right now it's quite low compared to its all-time high. I was wondering, what do you think of Nvidia?
Sure. You know, earlier in the show, I talked about the fact that the chip business was cyclical and had long runs of highs and runs of lows. And often they're precipitated by overstocking, you know, so you get, an insatiable demand for a particular chip. People realize it's in short supply, so they order more than they actually need. And what they say is, you know, the inventory channel gets stuffed, and you've got to work your way through that inventory channel before new production can begin. That's why there's such extreme highs and lows within this particular industry. Nvidia hasn't had that situation. There's insatiable demand. But even this morning or overnight, we saw that in China, the chip that is being produced for Chinese producers, and they call it the H20, has been banned by the Chinese authorities. And the reasoning is that they think their own technology is caught up sufficiently to compete with Nvidia, so they don't need it. Well, where does that end up? Well, it's now in the channel, and it's an indication of where some of the problems may lay. So when you're paying a very high price for these companies, as I said earlier, your expectations are for sunny days, but you've got to plan for rainy days. And I think with Nvidia, that's one of the things to consider.
Okay, let's go back to the phone line. Ray in Ottawa has a question. Hi, Ray.
Hi, thank you for taking my call, Gordon. I would like to know your opinion of Taiwan Semiconductor.
Right.
It's touted as the most important company in the world. It builds the vast majority of chips for all the big companies. It's done very well, and I'm just wondering if you would continue to buy at these prices. Thank you.
Okay, thank you for the question. So you talked about supply problems and cyclical problems with Nvidia.
Yeah.
How does Taiwan get through this kind of?
Well, I think, you know, you have to rank companies within their own industries. And you know, when we look at that whole subset of companies, Taiwan ranks very well. In fact, I think that Julian Nono-Wamdam was on your show just a couple of days ago and talked fairly extensively about Taiwan Semiconductor and spoke well of it, but also said, well, we don't own it at this point because we want to wait and see where things shake out in this particular industry. So anybody who's interested in that can go on the BNN website, I guess, and go to videos and watch Julian, a very impressive young man. Who's been with us some months, and we're very excited to have him. Taiwan controls about 38% of the foundry business in the semis. Putting that in context, Intel's at about 8%. So you know, as Ray said, they are the player in the semi area, and one to watch. They've done extremely well, and we're biding our time. We're watching. But we don't own it at this point.
Okay, let's try and squeeze in a last caller. Jazz is in Victoria, BC. Hi, Jazz. Jazz, are you there?
Yes. Hi there.
Go ahead. What's your question?
Hi. Thanks for taking my call. My question is regarding Tesla, and it's forward earning being over 120%, and demand keep decreasing around the world. We realize they have other industry, but how does Gordon see this company going forward? I'll just hang up and listen to your view.
Okay, thank you for the
Sure,
question.
Jess. We're not an owner of Tesla, and anybody who's watched me over the years has known that I've had big problems with the valuations. I have problems with the leadership group. They're just not predictable enough, and I'm talking about Elon Musk, of course. The latest bump in the stock was because
he bought a bunch of
stock. Yeah. Listen, I don't want anybody to misunderstand me. I think he's brilliant. As a scientist, I think he's brilliant. I think he's got a brilliant mind from a technology standpoint, a product development standpoint. But that doesn't necessarily mean he effectively runs companies well on behalf of shareholders. And I represent shareholders. So I have to be very careful about where we place our money. And we've chosen not to invest in Tesla for those reasons. I think that it's clear that the market's really not pricing out a car company because it's just not,
priced that way.
Well, it's not believable that it would be priced that way when GM and Ford are priced another way when they're really in the same business. Tesla is being priced as a technology company and what might come next, whether it's robotics or anything else that they might develop that would be ground shaking. And we'll have to wait and see until we get those types of products, what we think of them. But overall, we've got enough worries or enough sort of negatives with Tesla that we have decided to stand away.
Got it. All right, we're going to take a quick break. We will have a look at new picks from Gordon when we come back. Join us tomorrow on Market Call. Brian Madden on the show, Chief Investment Officer at First Avenue Investment Counsel. He'll take your questions on North American equities. Time now for top picks from Gordon Reid. He begins with Amgen on the NASDAQ. This is the company that does biotech, I guess, medicine biotech. Yeah. What do you like about Amgen?
Well, one of the oldest biotech companies in the world. First known for their blood product and their chemo product, Neupogen, Epogen, but now many products. They've got a very, very big portfolio. In fact, I was reading the other day that their revenue last quarter was up 9%, but they had 15 products that had double-digit growth in revenues in the quarter. So very, very impressive, and even better on the earnings front, over 20% growth in earnings. Trading at about 13 times earnings, 3.4% dividend yield. And I guess the sizzle, if you will, is with a product that is in phase 3 testing and will likely come to market in 2027 if successful. I'm assuming it will be. It's called Maritide. It is a GLP-1 drug, and it's an obesity drug. It's not a diabetes drug. It's an obesity drug. And
a pill injection?
Well, actually, at this point, it's injection, but just once monthly.
Ooh, okay.
So, everybody's looking for delivery systems that are more palatable, and people don't like poking themselves with pens.
Sure.
So it's a once a month injectable, and we will see a lot of these franchises go to an oral application, but we're not there just yet. But they're going to be a player in this area, and we think that it has the opportunity to be a game changer.
All right. Let's get to your next top pick, which is Qualcomm on the NASDAQ. And what are you looking for out of Qualcomm?
Well, we talked about the chip business quite extensively today, and Qualcomm is one of those. It's been held back a little bit by the fact that a lot of their chips are components of handsets, and the handset market, led by Apple and others, the Android-based products, have really not grown substantially over the last number of years. So there's been a lot of this channel stuffing and difficulties with Qualcomm, but they're moving away from that. They're getting into Internet of Things. They've got a very big automotive business, autonomous automotive driving business. So their chip sets are having great application in new technology areas. And at 13 times earnings, much less than a lot of the other chip companies we were talking about, we think it's a good place to invest.
All right. We want to get to your last pick, which is United Rentals. That's a bit of a surprise to me.
Why?
I don't know. It's just, guess I haven't really thought about it. And I'm just wondering what you see moving forward in equipment rentals that sparks either some growth or something new for them.
Well, they've been growing very, very rapidly. They've grown earnings 22% annually on average for the last 10 years.
Okay.
So really, really successful. When we first bought them, they were trading at about 10 times earnings. They're around 20 times earnings now. So the market has recognized their success. So we've had a valuation expansion. But boy, our clients have done extremely well owning this stock. I'm not sure it's a 10-bagger for us, growing tenfold, but if it's not, it's very close. So it's done extremely well, and we think there's lots of runway in the future. They only own 15% of the entire space, so it's a highly fragmented business, but they operate well, and they grow both organically and through strategic acquisitions. So they're a company to watch, especially with the many, many hundreds of billions or even trillions of infrastructure dollars that are floating around.
And sorry, do they do mostly small equipment rental or larger as well?
Both. They have a commercial side, but I think if you looked at their total business, I think most of it would be on the larger scale. So you'd see their equipment in large construction operations.
Good to know. All right, Gordon, thanks for coming in. We'll see you again soon.
Thanks, Marilla.
Gordon Reid joining us today. Thank you for watching Market Call. We'll see you again tomorrow.